Welcome back to the channel. If you're an investor looking for consistent income and long-term stability, you already know dividend ETFs are some of the most powerful tools available. But here's the thing, not all dividend ETFs are built the same. Some prioritize growth, others focus on raw income, and some act as a safety net when the market gets rocky. In today's video, I'll walk you through 3 dividend ETFs that deserve your attention in 2025, Vanguard Dividend Appreciation ETF, VIG, JPMorgan Nasdaq Equity Premium Income ETF, JEPQ, and Vanguard Consumer Staples ETF, VDC. By the end, you'll know exactly which one, or combination, fits your goals best. So, let's jump right in. Let's start with one of the most trusted names in dividend growth, VIG, Vanguard Dividend Appreciation ETF. This ETF is all about companies that don't just pay dividends, but consistently increase them year after year. Quick facts: launched in 2006 by Vanguard. Tracks the S&P US Dividend Growers Index. Requires companies to have at least 10 consecutive years of dividend growth. So what does this mean for investors like you and me? It means we're looking at businesses that are financially disciplined, have strong balance sheets, and have a track record of rewarding shareholders. Top holdings: you'll see names like Microsoft, Apple, Johnson & Johnson, and United Health Group. These are companies that dominate their industries and have strong cash flows that allow them to keep raising dividends. Dividend yield, currently around 2%. Now, that's not flashy, but here's the catch: dividends here grow over time. You're not chasing yield, you're chasing sustainable income growth. Performance: historically, VIG has returned about 9 to 10% annually over the past decade, a very solid number for a dividend-focused ETF. Expense ratio, only 0.06%. Basically pennies on the dollar. Risks: the main downside. VIG doesn't give you the highest yield. If you're retired and want maximum income, this may not be the best choice on its own. It's also tilted toward large cap growth, meaning you won't get as much exposure to smaller dividend growers. Verdict: VIG is an excellent core holding for dividend investors. It's reliable, it's cheap, and it focuses on long-term growth. If you want your dividends to increase steadily every year, this is a must-consider ETF. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Now let's switch gears to something a little different, and definitely more exciting for income hunters. I'm talking about JPMorgan Nasdaq Equity Premium Income ETF. This ETF is a game changer because it blends growth and high income. What is it? JEPQ owns many of the same stocks as the Nasdaq 100, think Apple, Microsoft, Amazon, and Nvidia. But here's the twist: it uses an options overlay strategy, specifically covered calls. What does that mean? In simple terms, JEPQ writes options contracts on its holdings to generate extra cash. And that extra cash is paid out to investors like you. Dividend yield: right now, JEPQ pays about 8 to 10% annually, and the best part: dividends are distributed monthly. That's a huge plus for retirees or anyone looking for regular income. Performance: since its launch in 2022, JEPQ has performed well, though it does sacrifice some upside in exchange for that income. Because of the options strategy, when tech stocks soar, JEPQ won't capture 100% of that upside. But in return, you're compensated with a steady, fat dividend check every month. Expense ratio, 0.35%, a bit higher than Vanguard funds, but still reasonable given the active management and options strategy. Risks: the big risk here is the trade-off. You're capping growth in exchange for income. Also, it's heavily concentrated in technology. If tech goes through a major downturn, JEPQ could take a hit. Verdict: JEPQ is for investors who want high cash flow right now. It's not a pure growth ETF, but if you're looking for reliable, high-yield, monthly income, this fund is tough to beat. Finally, let's talk about defense, because as much as we love growth and income, sometimes markets get rough. That's where VDC, Vanguard Consumer Staples ETF comes in. What does it hold? VDC invests in essential consumer staples companies, things people buy no matter what's happening in the economy. Think Procter & Gamble, Coca-Cola, PepsiCo, Walmart, and Costco. Dividend yield, around 2.5 to 3%, so more than VIG but less than JEPQ. Performance: historically, VDC has returned about 8% annually over the past 10 years. Nothing explosive, but very consistent. Why it matters: consumer staples are defensive. When recessions hit, people may cut back on vacations or new gadgets, but they still buy groceries, beverages, and household products. This makes VDC a stability anchor in your portfolio. Risks: the main downside is limited upside. Consumer staples aren't growth engines like tech. You're trading excitement for stability. Verdict: if you're worried about uncertainty in 2025, like inflation, recession risk or market volatility, VDC is a strong way to balance your portfolio with a defensive, dividend-paying sector. So, let's bring this all together. VIG is the king of long-term dividend growth. Perfect for investors who want dividends that rise over time and a rock-solid core ETF. JEPQ is the income machine. If you want high, consistent monthly cash flow, this one stands out. VDC is the defensive play. It won't wow you with returns, but it's stable, reliable, and pays steady dividends. Now, which one is right for you? That depends entirely on your goals. Younger investors might lean toward VIG for long-term growth. Retirees who need cash flow now might prefer JEPQ. And cautious investors, or those worried about market volatility, will appreciate the defensive strength of VDC. Remember, you don't have to pick just one. In fact, combining these ETFs can give you a balanced mix of growth, income, and defense. So what do you think? Which of these ETFs fits your investing style best? Let me know in the comments below. And if you found this video helpful, don't forget to hit like, subscribe, and ring that notification bell so you don't miss future breakdowns on dividend investing. Thanks for watching, and I'll see you in the next video.